Well, to talk markets, let's bring in our next guest. He's Michael Dehal, Senior Portfolio Manager with Dehal Investment Partners at Raymond James, and he's in studio with us right now. Thanks for coming in.
Thank you, Paul.
So what do you, it's been quite a first half of the year. A plunge in the first half of the year. Investors were really worried about what tariff policies were going to do to the U.S. economy, the Canadian economy, the global economy. And then on a dime in early April, these markets took off, and that rally looks like it's continuing right to this very day. How do you explain this to your clients? What should they understand about the first half of this year?
Yeah, Paul, it's a great question. It's been a roller coaster of the first 6 months of the year. From early January into middle of February, we see the market surge. And then from there, the markets tumbled 21% into April, as you mentioned, amid the trade tariffs. And from there, we had a strong rally into middle of May, into June. However, if you actually look underneath the surface, especially the last month or so, that rally, the breadth has only been about 60% of the equities in the S&P. Above the 200-day moving average, as well as the momentum has been actually limited to a few stocks in the tech sector.
Does that cause you concern about the health of this rally?
It does. It does. Valuations are back at highs again. S&P 500 trades at 23 times forward earnings, so that is a bit concerning. There are still risks out there. The trade tariffs could come back online July 9th. I know Trump has made a deal with Vietnam, and there's a few other countries that trade deals could come through over the next week or so. But there are certain risks that do persist out there.
Okay, what about the Canadian stock market, which has been a star performer in North America? It's significantly ahead of the, on a year-to-date basis, of the big indices in the U.S., even though those indices have been roaring lately. The material sector up 30% so far this year on the TSX. That's largely a story of the golds. The consumer discretionaries up 15%. The utilities index up 7%. The financials up 9%. Some of the big sectors on the S&P TSX composite here in Canada have done very, very well.
Absolutely. TSX has outperformed the S&P 500 the first half of the year. That's led by commodities. In particular, gold and base metal stocks have outperformed. As well as Q2, financials have definitely provided a boost for the TSX with strong bank earnings in Q2. And we do expect materials to continue to outperform as trade tensions between the U.S. and Canada ease up.
So what is your outlook for the remainder of the year? And what is your recommendation to clients in terms of the equity market exposure that they should have in their portfolios?
So the remainder of the year, we do recommend diversification. If you look at the first half of the year, the U.S. dollar did weaken. We had the worst dollar index performance in the first half of any year since the 1970s. However, that did boost up international equities, European equities, emerging markets, as well as commodity markets. So as an investor for the second half of the year, we do expect increased volatility with trade tariffs, with inflation possibly reaccelerating, and also the labor market.
You expect pullbacks, in other words. Volatility means pullbacks.
Exactly. We do expect pullbacks. Well, we are still constructive on U.S. equities and international equities as well. So any major pullbacks, we are buyers of the dip. However, we do caution investors to use diversification, spread your money across different sectors and geographies internationally.
How much tech exposure should investors have? And that's a question that investors have been asking themselves for a long time, for many years. But over these past 5, at least, these years of the Mag 7, that's been a big question. And sometimes investors regret not having as much exposure as they might have.
Yeah, if you look at earnings growth from the S&P 500, the majority of the earnings growth has come from the tech sector. The first half of 2025, the key drivers were tech dominance and AI. Companies like NVIDIA, Microsoft, Meta, Palantir were standout outperformers in the first half. So Mag 7, we still got earnings growth. We still like the Mag 7 into the second half of this year. They've got earnings power, strong balance sheets, and good free cash flow.
How should we think about the U.S. economy as a driver of markets or an environment of markets? Once again, the market is now taking a rate cut off the table. The July rate cut is now gone, according to the the overnight swaps market, the Fed funds futures market. When this year began, investors were very optimistic that there would be 4 rate cuts from the Fed. Now we're wondering if there'll even be 1. How important are rate cuts to this market, or do you take the other view that the U.S. economy is not nearing a recession, is continuing to advance?
Yeah, there's 2 sides of the story. If the U.S. economy is strong, why do we need rate cuts, right? This morning we had a job numbers come out. 147,000 jobs were added to the U.S. economy, higher than expected. So that does pull the July rate cut off the table. However, we do expect a cut in September and a cut in December as inflation cools down back to the Fed's 2% target and the labor market cools down as we progress into the second half of the year. We could see 1 or 2 rate cuts for the Fed.